first idea is called Coloplast. What do they do? Where do they trade, Brett?
Yeah, so Coloplast is a Danish company. They're the global leader in ostomy care, continence care, and the third largest in wound dressing care. So this is a healthcare company. Like with Danaher, healthcare had a strong 20, 21, 22, weakness in 23 in terms of destocking. They do have some China exposure, but their business is really looking like it's going to grow over the next little bit. 75% of the revenue comes from products or services, or and devices that are used in chronic care. So unfortunately, if you have some sort of medical ailment and you need a Coloplast product, it's likely that you'll need that for the balance of your life. They've done two big acquisitions. So there was a company called Atos that provides stomas, and Caresis that's wound care. Little interesting aside there, Caresis is a company, they found that if they take cod skin, it's far enough away from human skin that they can sort of graft it on.
And the immune system?
And it doesn't recognize it exactly, because the challenge is sometimes if you get something too close, like a mammalian graft, then all of a sudden the body attacks it. Cod skin far enough apart, and there's some healing, regenerative properties to it. So that's been a big acquisition for them. They'll continue to grow through channel expansion. Fortunately, there's more and more people that need their products. They have good M&A chops, and the R&D engine is always turning. So if we look at this company and we think about it over the long term, the dividend growth rate's been about 11% per year over the last 10 years, and the shares have grown by about 12% per year over the last 10 years. So oftentimes, if you can find a company that's growing its dividend, growing its net income, growing its revenue, sort of growing those three things, that tends to be growth in share price.
Your next idea, tell us.
Yep. So this time, sometimes we have things that are just obvious and they're in our backyard. If you look at TELUS, the company's yielding over 6%. So if I'm looking for a 10% return in my portfolio, I can get 6 from dividends. I only need about 4% from price. They just reported in their recent quarter that they had 1.2 million new mobile and fixed subs. So that's the highest growth in subscribers over any point in time in the company's history. They've raised their dividend by 7%. And they do have challenges, absolutely. Just like BCE and like Rogers, there's been an investment in infrastructure that they're going to have to make back over time. But this is a company that's not going anywhere. They're benefiting from the immigration in Canada. And again, if I think total return and I can get 6 on the dividend, I only need 4 in price to make my 10% in the course of a year.
Okay. TELUS competes with our parent company, BCE, parent of BNN Bloomberg. Your next idea, Littelfuse. Now, they're big in circuit breakers and things?
Yes. That's right. So part of the whole EV electronification of the world is you need the component parts. And so Littelfuse is a small cap. It's about $6 billion in market capitalization, so quite a small company. They provide fuses, they provide circuit protectors in the automotive, in the industrial, and importantly, in the data center markets. Wow. So if we're thinking about all of this AI and all of this compute power, we have to have the data center spun up to take advantage of this. The interesting thing about this company is they've, over the last number of years, been very successful at growing the business organically about 5 to 7%, and then again, strong M&A chops. So they're going out and they're adding another 5 to 7% through M&A. So if you can find a business that's growing at 10 to 12% on a recurring basis, it doesn't take that long for the business to double their earnings and effectively double the value of their stock. So again, if we look back over a 10-year period, we see a dividend growth rate of about 12% per year. Shares have actually compounded a little bit faster, so the compound average growth rate of the stock price over the last 10 years has been about 20% per year.
And I suppose if people get excited about their data center involvement, that could increase the multiple as well.
Absolutely. Yeah. With these small caps, they tend to have multiples that move upwards and downwards quite quickly. So we saw in 2023, there was compression in the multiples across the small cap space. We're moving, and it was really sort of October, November of the end of 23 and into 24, multiples are starting to expand. So you can have two forces pushing the value of the stock higher. One is growth in earnings, right? If we can continue to execute on that 10 to 12% growth per year. And then two, the market assigns a higher multiple, then you can have two forces that are pushing the share price up.
Brett, thank you very much indeed.
Thank you for having me.
Okay, let's get to the first idea from Teal Lind, Blue Owl Capital. Owl on the New York Stock Exchange.
Yes, the Blue Owl is basically riding 3 waves in the investment world. The first one being the growth of private credit, which is mostly direct lending. Brookfield has cited private credit as expected to be the fastest growing asset class within alternatives. All right, and then the second one is they're taking advantage of the growth of sale and leaseback transactions with investment-grade companies that want to monetize their assets, and so they become tenants of Blue Owl on a triple net lease basis, where the triple net lease is where the tenant pays for all the operating expenses. And so Blue Owl, based on their assets under management and the funds that they have, they are the industry leader based on the AUM in that particular niche. And then the third area is that alternative investments have largely been reserved for institutional investors, and so they're trying to democratize that and bring alternative investments that they sort of invest in to the retail investor by investing in the people and the products that distribute that to the broker networks that get to the advisors and their clients. And so the three of these growth waves are resulting in 20% roughly revenue and earnings growth this year and next year, trading around 22 times earnings, and they just raised their dividend 30% on Friday for just over a 4% yield.
Okay. Five Below, you've long loved this company. They market, I think they target teens, and the stuff is $5 US or less.
That's right, yeah. And it's, I mean, in Canada, just for reference, Dollarama has been a phenomenal success story. And they're up to about 1,500 stores. So they have a goal of getting to 2,000 stores by the end of this decade. So they're starting to run out of room to build new stores. Five Below has 1,500 stores roughly today in the United States, and obviously a much larger runway ahead. They have a 1-year payback now on their new stores, so they can internally finance their growth without taking on any debt. And they expect to grow their store count by about 15% per year for the near term.
And they actually have Five Beyond, where they sell stuff above $5, you say?
Yes, within the stores, they have a Five Beyond section. And I think when they started the store back 15, 20 years ago, they figured they didn't figure inflation ever become a problem. So you got to be careful when you name your company after a certain price point. And so now they called it Five Beyond, and it's a portion of the store where they sell items that are beyond $5. What's interesting, though, is that they're finding that it's not the average transaction receipt that's going up, is that they're actually getting more transactions whenever they introduce this to the store. So people are coming in the stores more often because they have this $5 and beyond there.
Want to check it out.
Yeah, and buy.
Okay. And then finally, TD Bank, they have this regulatory dispute in the States hanging over them over money laundering, or lax controls allegedly on money laundering. Yeah,
that's right. They get in a bit of trouble there. And so what they've had to do is they've announced that they're going to spend $500 million of after-tax expenses on compliance and risk management in that area. And so the banks overall, their fundamentals are getting better. And in the fourth quarter, the banks all sort of announced their charges and they buried into the fourth quarter, so they have a nice clean year going ahead, except for TD Bank. I mean, they announced some charges, but they also announced they have these expenses coming up this year. It's weighing on the stock, but I suspect 12 months from now, most or all those expenses will be behind them, and the stock will then probably likely catch up to its peers.
Oh, is it trading at a discount?
It did. When they announced, in the fourth quarter, all the banks announced their results, and most of them, except for Bank of Nova Scotia, moved up. TD Bank also did not move up because they announced that expense. So it's just going to take some time to work through. They work their way through that, and then they can catch up. So it's more of like a catch-up trade.
Teal, thank you very much indeed. It's always great hearing from you. Chris's first idea is Brookfield Infrastructure Partners, BIP.UN.
Yeah, so this is one that I think is a really interesting opportunity. You know, very, very inexpensive valuation, about 9 times funds from operations, 5% dividend yield, and a very unique kind of operating capability. You know, what they is Brookfield Infrastructure is kind of a large global infrastructure company. And so they have a number of different operating segments. But because, of their Brookfield affiliation and the sponsor support, they're able to do counter-cyclical acquisitions. And if you look at, what they were able to do last year in a really tough time where a lot of, businesses, and especially in the infrastructure space, were sitting on their hands because, they couldn't refinance debt, they couldn't go out and be opportunistic. This is a company that is built to go against the grain, and you're going to reap the benefits of that of those acquisitions in 2023 for years to come. So I think this is a kind of a must-hold for income investors, and I think this provides you with a good combination of growth and income. So, for a nice total return.
Your next idea is Yum China, a play on fast food in that economy.
Yeah, I think this is one too. I've talked about Yum China before. Like China, in terms of Chinese equity valuations, like they are definitely in the toilet. The Chinese equity market is trading at less than 10 times earnings, right? And if you look at this, is a first-class operator, and this was spun out of Yum Brands. So Yum China is the Chinese footprint for Yum Brands. And if you look at their capabilities, this is a company with a rock-solid balance sheet, no debt at all, and net cash of north of $2.5 billion, a great management team, great digital capabilities. And so when there's been distress in the Chinese market, they've taken this opportunity, because they're well capitalized, to accelerate their growth plans and increase their store counts. And so I think this is a really unique business, kind of a best of breed type company at a pretty depressed valuation. It's 16 times adjusted earnings, and you do an adjustment for the cash on the balance sheet that's excess. But if you compare that to Yum Brands, you compare that to McDonald's, QSR, they're all trading at 23 times. So I think this is a business that has a better growth outlook than almost every company in its space, and an evaluation that's about a third lower. So I think this, sets up for a nice total return over the medium term.
And a loyalty plan with more than 400 million members?
It's crazy. It's crazy, because China, everything in China is just so big because of the population, but their digital capabilities it's over 400 million people that on their app. I mean, it's bigger than the whole population of the U.S. And I think that just highlights, how well they can grow.
And then finally, RTX used to be part of the Raytheon entity.
Yeah, and so this is another one, kind of a little bit out of favor and a little bit down in the dumps. So this is, this is an aerospace and defense company. And what's unique about it, there's, kind of a fairly even mix between the aerospace and defense. And, both of them, massive demand and quite strong top-line growth and good profitability. What's happened to them recently is they're dealing with this powdered metal issue in their jet engines business. And so this has been this was kind of announced last year. It's a negative overhang on the stock. From a cash flow perspective, it hasn't hit the company yet, because the added service costs are going to come in over the next 2 to 3 years. But I think this is a company that, again, the one theme of all of the picks today is these are companies that can go against the grain, rock solid balance sheets. They can operate in a counter-cyclical manner. And so you see Raytheon Technologies accelerating their share buyback plan, as the stock has gotten hit. And I think it's a very, very inexpensive multiple, around 16.5 for a business that is so strong. But there is some headline risk in the aviation space, and there could be some negative overhang associated with that current issue that I mentioned.
Chris, thanks very much. Topic number one, ASML Holding. As you advertise, it's a chip-related idea you like.
Yes, so it's basically a semiconductor manufacturing equipment maker. So they make the machines that sell to Intel and Samsung and Taiwan Semiconductor. Those are its top 3 clients or customers to make chips. So they make the equipment that makes chips. They specialize in lithography systems for advanced semiconductor chip production. They play a really crucial role in chip manufacturing. In fact, when you look at any advanced chip in the world right now, it comes from a machine that ASML has produced. So they really have a pretty close monopoly in that space. Obviously, artificial intelligence, AI, 5G, and automotive technology is the way of the future. And this chip manufacturing, this equipment is very, very crucial to those areas. ASML, as you can imagine, really stands to benefit greatly from the growth of AI due to increased demand for advanced semiconductor chips required to power these AI applications. AI technology will continue to advance. There's going to be more and more demand for more powerful, more energy efficient, more quicker chips. That's going to drive more demand for ASML's lithography systems and machines. So that'll obviously translate to stronger revenue and even stronger earnings growth going forward. If you look at the share price today, it seems to be breaking above the 2021 high. So this is a breakout here potentially. Last month, they've reported a quarterly earnings and revenue beat over analyst expectations. We're looking at about 17% earnings growth going forward.
Your next idea, big drug distributor, Cardinal Health, or a
Yeah.
medical distributor anyway?
So they distribute pharmaceuticals and medical products to healthcare providers such as hospitals, pharmacies, and clinics. In fact, their largest customers would be CVS and United Health Group, big managed care company. They basically operate in a triopoly industry alongside of McKesson, another name that we own, and Cencora, another drug distributor out there, which the three of them control 90% of the U.S. pharmaceutical wholesale industry. So you've got a bit of a oligopoly or triopoly type of industry whereby prices and remain pretty firm. And they're able to leverage in their supply negotiations and basically result in predictable cash flow. I think longer term, you look at demographics, you've got an aging population, that's going to result in more and more spending and volume in prescription drugs. Today, as I mentioned earlier, 60% or around 60% of all Americans regularly use prescription drugs, one prescription drug, and 30% use two or more. These figures are going to increase over time, particularly with the issue with diabetes becoming more and more of a problem. And now you're going to have a growing demand for diabetes treatments. And then the weight loss treatment drugs, that area is expanding very quickly. So we're going to need more companies like, or more movement from companies like Cardinal Health and so forth. So the shares have been trending higher steadily, above a 200-day and 200-week moving average. So good technical strength there. We see about 15% earnings growth from this company going forward.
And then your final idea, a stock that has been hitting record highs lately, Dollarama.
Yeah, Dollarama has been doing very well. It's the largest operator, as you know, of discount retail stores in Canada. There's 1,400 locations today. They aim to grow to 2,000 locations in Canada. They obviously have a very resilient business model that can do well in almost any economic environment, strong or not strong. And then you've got this growing consumer demand for value-priced goods. Given the type of inflation we have out there, given the tax environment that we have out there, there's more need for value-priced goods out there. They've done extremely well. Their operational efficiency surpasses many companies. Strong financial performance, steady revenue growth, healthy operating margins. You're not going to find something for $1 anymore. It's going to be more like $5. They're going to expand their product mix to a $5. Some of their products will be $5, not $2 or $3 and whatnot. Last summer, they introduced a share repurchase program. So, it's creating shareholder value for management. They're going to buy back 13.6 million shares in the market. Revenue growth has been 10% a year for the last 5 years. And again, as I mentioned, they're going to grow to 2,000 stores. And we see about a 17% earnings growth forecast for this name. And stock prices moving higher highs, higher lows, ascending pattern. So technically also a strong name to own.
Stan Wong, thank you very much indeed for joining us, Stan. Okay, let's get to the first idea. It's a long-standing, a name that we haven't heard very much about, 3i Group. It trades over the counter. What do they do, Jamie?
Yeah, so 3i Group, we're talking about a private equity company that we'd be looking at instead of Brookfield. This is the most recent company we've purchased in our Global Equity Growth Fund. So 3i is it's private equity. It's actually I think it's about the 25th largest company on the London Stock Exchange now. So it's one of these companies that doesn't get a lot of attention, but has slowly been one of the best performing stocks over the last decade, we think. And 3i Group's main investment is a company called Action. And Action is one of the largest low-cost discount retail stores in Europe. And so it started in Netherlands. It's moving across Western Europe, now growing in Eastern Europe. They have about 3,000 locations. And we think Action is a retailer in the likes of Costco, Dollarama, Five Below, these great retail growth stories that you can purchase at a cheaper multiple than all three of these companies, and maybe even has a larger growth opportunity than a lot of them. And so outside of 3i Group, or Action makes up about 75% of 3i Group's value. And then being a private equity company, they have investments in some other companies. It's permanent capital, so they're just recycling the same capital over and over. They're not raising money from investors like a company like Blackstone. So it's just a phenomenal growth story. They have some other investments that they think could become very, very long-term holds, like this retailer Action. And it's really, like we said, I think it's exposure to one of the best retail metrics we've ever seen at a very, very low price.
Next idea, AstraZeneca, big name in pharma.
Yeah, so AstraZeneca is going to have the highest growth rate in the pharmaceutical space outside of the GLP-1 companies like Eli Lilly and Novo Nordisk. The only difference is, I mean, those are going to grow much, much faster, but your investors are paying a very, very high multiple, 60, 70 times in Eli Lilly's case, I think. Where AstraZeneca trades at a much more reasonable multiple of 15 times for next year's earnings. It's going to grow its revenue about 10% over the next decade. And AstraZeneca, it's really been the leader in oncology. So they've built one of the best immuno-oncology franchises in pharma. And as we move into the next phase of oncology, we're seeing these smart chemo drugs. And these are chemotherapy drugs that can target just the cancer cells as opposed to current chemotherapy. That's more of a blanket approach to any cells in the body. So could be very transformational for treatment of cancer. And AstraZeneca, we think, is a leader in the space. And being able to buy it again at 15 times, we think it could be a home run.
Okay, and then your final idea, Manulife. Now, these shares have been rocking and rolling lately.
Yeah, I mean, was the 8% move or 9% move yesterday justified based on the earnings? Maybe it was a little bit ahead of itself, but I think the key here with Manulife is this is a company, you go back to 2010, they raised a bunch of equity, they made a fortress balance sheet, and the stock went nowhere for the next decade. And that's because when you have too much capital not allocated appropriately, it's hard to create value in the insurance market. But the new management team and new CEO who's in place, we think is doing all the right moves. They are selling down some of their problematic assets, which is a huge, for the price they're getting, they're able to use that to buy back stock and leave the remaining company as a higher return on equity entity. And we're seeing, again, we're seeing a rebound in the Asian market where Manulife's a huge player starting to come through. I think really this is a call of, I don't think you're going to get another 25, 30% in the next year, but Manulife is, if it's a giant ship that has been spinning in a circle for the last decade, it's finally, moving in the right direction. And for long-term holders who have been holding this, we would keep holding it. We think the share price is going to continue to march higher and higher. The dividends are going to continue to grow. And, it's a core holding in our income fund portfolio, and I think it should be a core holding in any Canadian investor portfolio looking for dividends.
It is still, I mean, it's shot up lately, as we just saw. It's about $33 right now. It's interesting. It is still down from a record high just north of $44 during the financial crisis. If I remember rightly, it turned out they were far more equity exposed than people had thought.
Yeah, I think during that 2004 to 2007 timeframe, they were selling, like you said, basically equity-linked products that were leveraged to the market. And so when the market goes up, that's great. When it goes down, that's not great. So,
did it ever? It was a pretty violent collapse after that. Yeah, it subsequently went in pretty short order below $10.
Yeah, there's definitely. I mean, there's some key questions around that, and that's when they decided to make this fortress balance sheet in response to what happened. But I think they did that at the wrong time in the market. You take away all the upside at the bottom of the market when you do that, and now it's in a point where it can grow nicely year over year. The dividend should move higher. It still is not cheap on any sort of metric. It trades about an 9 PE ratio, and we think if you've been holding it for a decade, I would hold it for the next decade. It'll be a better decade, I think.
Okay, and a yield of about 4.8%. Jamie, thank you very much indeed.